This week on the Art of SBA Lending.
Local agencies, the local folks, they're helping primarily the farmers. What in the heck do they know about doing multi-million-dollar loans for a hotel?
$1 billion here and $1 billion there, and pretty soon you're talking about real money though, right?
30-year term.
Yeah,
This is
5 more than SBA. We go full 30 on real estate deals.
Everything's 5 more. Everything's 5 more with
Premiums
USDA.
5 more, terms 5 more. Prepay is also 5 more.
In 2020, the banking industry was forced to accelerate into the future, and now there's more innovation than ever before. And many of my colleagues are embracing these tools, and they're winning. But the banks that are slow to adapt, well, frankly, I'm concerned. Here's an example. Bank A uses Lumos and has over 1 billion data points at their fingertips that allow them to, within seconds, access all this data. Local economic data, industry insights, even a predicted expected loss. And Bank B, well, their underwriter spends hours Googling it. Which bank do you think is going to be winning 5 years from now? Guys, we can finally make credit decisions using actual data. Let Lumos take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today. Hello and welcome back to the Art of SBA Lending. Today's topic, rural lending. The USDA. Whenever I feel bad about people talking crap about the SBA being the lender of last resort, I look over to my friends at the USDA and I feel a little bit better about myself. But like the SBA, how much of that perception is reality? This may come as a surprise, but I know very little about USDA lending. I've never even done one. I brokered one once, like 8 years ago. It was a hotel, and I think it took like 6 months. But with SBA lending becoming more and more commoditized, the USDA program is actually looking kind of nice from a business perspective. Is the secret finally out? Is USDA lending the last frontier? Today we find out. We're diving in deep on USDA lending to learn what it's all about, why it is the way it is, and I ask the question, should the USDA B&I program be absorbed by the SBA? I know, it's controversial. Let's bring in our panel. Joining me today, we have Steve Small, Jason Hoerr, and Charles Conoley. Fellas, thank you for being with me today. So Jason, can you give us a quick overview of the USDA lending programs that are available to small businesses today?
Sure. So the USDA, U.S. Department of Ag, which is kind of an initial point of confusion for a lot of people, is how does the USDA Department of Ag do commercial finance deals? From a congressional standpoint, the USDA's mission is to stimulate economic activity out in rural areas. Part of their function is to create jobs. So back in the 1970s, I believe, Charles may actually have a good read on the history. Mike Thomas and a couple other guys, businessmen and businesswomen got together to spearhead the creation of the USDA government guaranteed programs that was largely based off the success of the SBA. And so it's been rolling for about 50 years. And for everybody that's familiar with SBA, it's very, very similar in terms of how the program functions mechanically. It's the lender gets a government guarantee to put capital out. And, if you're out in these rural areas, the general population is like 50,000 and less to qualify typically. And the loan amounts are bigger than SBA. They go up to 25 million. So, if you're trying to get 15, 20, $25 million in debt out in a really, really small tertiary market, it's difficult to raise that kind of debt financing typically. Most of the time, the banks that are out in those areas, these loans are above their legal lending authority. So they're stuck. And then the big banks in the city, they don't want to go out into these tertiary markets. So the USDA B&I program specifically is a bit of a magic bullet in the commercial finance world because it allows borrowers to access capital that oftentimes is difficult. So that's kind of a quick down and dirty. The USDA B&I is the program I think we're going to talk about today. And then there are 3 others. There is the Community Facilities Program, the Renewable Energy for America Program, and Charles, what's the 4th one? I just want
you got wastewater.
Wastewater.
Doing a wastewater program, and then underneath the B&I program, there were some subset programs specifically for timber production. But if you just say B&I under RD1, which is created in October of 2020, it consolidated a lot of the programs pretty much under one standard for both for-profit and not-for-profit business, which is different from SBA. You have to be for-profit business to get an SBA loan. The other things that go along with USDA, you already mentioned, much larger loan amounts. You can do investment real estate, whereas with SBA, it's just operating company, unless you have a ownership of the real estate only for the operating company. So there are some significant differences. I think the culture is also somewhat different. In my mind, SBA functions more as a insurance company. And I think you hit the nail on the head. The USDA is to stimulate loan activity in rural communities. So it's mostly about job creation or retention. I don't think that's the primary focus of SBA. So
I don't know. I feel like it is. I mean, isn't it also, Steve, an insurance program? Like, is the USDA guarantee similar to the SBA in that sense?
I would say, Ray, that it's similar in the fact that it secures the borrower's ability to get a loan. It provides the same function as providing that assurance. So in that respects, yes, it would be similar.
Maybe I'm misunderstanding this actually. So like SBA is I've always said it's a job creation program. I think it is. I mean, we have to document how many jobs you're creating and retaining, and that's a big part of it, along with just, economic activity in our communities. But is there anything I'm missing there? How is USDA different?
what I'm trying to highlight is with the USDA doesn't repair a guarantee like the SBA. When there's a problem, the SBA becomes much more surety or insurance institution, whereas USDA is worried about maintaining that business or jobs in the community and gives a lot more leeway and works with the lender, even if the lender hasn't followed all the program requirements like they should. If the intention is good to work to try to create or retain jobs, I think, and I've been doing USDA lending for about 25 years now, I only know one instance of a repair on a guarantee, and that was a bank, I believe it was in Georgia, that the customer and the banker worked to fraud the USDA, and that guarantee was repaired. But other than an extreme situation like that, there is no repair that I know of going on with the USDA program, because they understand, especially if it's a rural lender that might not have the best systems or processes in place, they might have a hard time maintaining all the requirements of the USDA guarantee. But if they work in good faith and are working with the USDA to make that loan continue or stay in place to assist that business, because the primary function of the USDA when they created that program was all about jobs, to replace the lost ag jobs in a community with other types of, because in the farming community, as the ag business became mechanized and they lost a lot of jobs, all the ancillary businesses in a small town dried up and went away. So they're trying to bring other types of employment into these rural communities.
Culture is exactly right, because that is very different than SBA culture. I mean, we panic about these guarantees on a daily basis. Jason, you were you worked at a huge USDA lender, right? I mean, what was your experience there with the culture?
Yeah, so I mean, the big difference between the two programs when it comes to the guarantee is on the SBA side. Of course, if you're doing any kind of volume, you have PLP status, you're a preferred lender. And on the USDA side, no such designation exists. It doesn't matter if you're the top lender in the country, no PLP status exists. So the difference is on the USDA side, every deal that you do, you're taking to the agency for approval before you fund the deal. Whereas on the SBA, as we all know, you're generating your own authorization in-house. So that just changes the dynamics of the repair potential of the guarantee if the deal goes sideways, because on the SBA side, it's a lot easier for the agency to say, hey, we don't know anything about this deal. You guys are a PLP. You generated your authorization. How do we know, that there weren't major mistakes made in the origination of the deal? So they're going to dig in and audit and do the thing. On the USDA side, that's not the case. They've seen the whole deal. They know everything about that deal. In order for you to get approval on the front end, you're going through state and potentially national office review on the deal, depending on the size. So it just changes the dynamics if the deal does start to go sideways, because USDA's got some actual skin in the game, right? Like they've reviewed and approved the deal. So there's not as much tension, I don't think, on the guarantee side of it because of that dynamic.
That's great. Yeah, USDA will assign loan officers. They'll do site visits. They're much more hand in hand with the lending institution to try to see if the project is worthy of the credit. And we can get into underwriting a little bit later, but really, to me, USDA lending is conventional loan with a guarantee. SBA is a little bit different type of lending in many cases because you can do collateral light in some situations that would not be normal under conventional lending. And the USDA pretty much wants the bank to follow its conventional lending policy and then provide the guarantee.
Steve, give me an idea of how big this market is, the USDA market.
The market itself, day in, day out, year after year, the USDA budget's roughly about $1.2 billion. This year is a little bit different in that there was some rollover money and then there was some extra money put in. So this year's the actual funding was just over $4 billion. Now, the market itself is really the capacity of USDA allocation. The last few years, that $1.2 billion has been spent by year end. So that would be about your capacity. If the loan right now, they're running about, with that $4.2 billion in budget, they have about 2.7 right now and pending guarantees of 632 billion. So they got about 2.1 billion left. So that means the capacity, and we're at the end of the fiscal year. So it's roughly about, what's that? 630, 1.2, 1.4. That's right at $2 billion this year is what's going to be used for 2025. Is that the true capacity of the market? I don't think so, because of some of the issues with what we've had with USDA, turnover, early deferment. A lot of employees have, as Jason and Charles know, a lot of the states are having a lot of issues with staffing right now. So that's posed a problem, a challenge, not a problem, a challenge. The national office has come up with a few ways to approach those by taking more load to the national office instead of the states handling. So that's morphing right now, and that's something in transition right now with USDA.
And that's compared to the 7A market's closer to like 30 billion. So relatively speaking, you can see how small it is. And I'm just trying to, so you've got to work with the government on a state by state and sometimes federal basis to really get into every individual transaction. And you're saying a lot of this lending is based on the capacity at USDA. And I just checked my calendar. It is 2025. You guys know this sounds nuts, right? Like, how is it that people are able to wait to go through that process? I mean, when you're talking to borrowers, are they like, no, the seller is not willing to wait? I mean, how long does it take? 6 to 9 months?
No,
it shouldn't. It shouldn't. I mean, really, the reason.
Okay, so there you go, right there. That's a what do you call it? A misconception right there, right off the bat. Go ahead.
For sure.
Yeah, acquisition loans are much quicker than project lending. Project lendings take quite a bit longer, but if the acquisition loan package is complete, and especially if it's within a state authority, you should be able to get an approval. Once your bank approves it, the bank has to approve it first, 2 to 4 weeks. So it's not near as long a process, but when you get into project lending, building something from the ground up on projections, feasibility studies required, a lot more environmental due diligence. Yeah, those projects can run out quite a bit of time.
That's not too bad. Okay. Before we get into the episode, I want to tell you a quick story. I was at the BDO retreat earlier this year, sitting next to Dustin Baker and one of the Shatterbox learners that he had recruited into the SBA industry. Her name is Sarah. And Sarah told me that she closed $10 million in her first 6 months as a BDO. I look over at Dustin and I asked him, why would anyone hire an $8 to $12 million producer anymore? Sarah is one of many Shatterbox learners who has proven that you can take a smart young person with no SBA experience, teach them SBA, and in many cases, they will outproduce seasoned BDOs right out of the gate. Why are we so willing to hire a mediocre BDO with a 6-figure salary when you can hire your next rock star, someone with unlimited potential, for half the price? You have no more excuse. Shatterbox has created the best learning platform ever created for the SBA lending industry. Join the 20 plus Shatterbox clients who have already taken the plunge on building talent from the ground up. I'm going to leave a link down below just for Art of SBA listeners. So if you want to learn how Shatterbox can help you hire and invest in bright young talent without breaking the bank, reach out and set up a discovery call today.
One of the big issues is the misunderstanding of GAAP balance sheets and how that plays a part of things. So that sometimes will throw lenders off. It'll take longer for them to get through those. But if you have somebody within the lender like Jason or myself as a 29-year veteran loan packager, we know the people at USDA. We know the processes. I'm sure like Jason, I've worked in multiple different states, so they all work a little different. But now we're morphing, right? The agency is morphing right now into they're trying to get more standardized. They're trying to streamline processes. So right now we're seeing a little bit of shift. We are seeing they reached out to a few banks that I work with. Bayfirst, Mr. Conoley's bank is one of them, to become what they call a national lender, where they signed a national processor to that lender, and we don't even work with the state at that point. They might send the state out to do the site visit and that kind of stuff, but we're now directly working with the national office and bypassing the state. So there's not two sets of underwriting eyes, so to speak.
I mean, you're following the footsteps of SBA. The SBA started with getting loans approved in local districts.
That's correct.
And then moved towards a national processing. So when you look at SBA, Jason, do you feel like you're looking into the future of what the USDA will become?
That's a really, really good question. I know there's a big drive in the USDA leadership team to try to, like Steve was saying, standardize the program and drive a lot more efficiency. So I think they're just going to keep taking steps in that direction. I mean, the transition they're going through right now with the national reps is huge. That brings in a ton more efficiency into the process. The real win would be if they ever drop the PLP status. That would be like a transformation of the program. But moving toward the SBA, more funding and more autonomy on the lender side would be fantastic.
But if you go into PLP, then don't you get into the culture thing? Because, I mean, that's the problem we're dealing with. It just becomes a different beast. I mean, ultimately, it just becomes like the SBA is, right? I mean, we were talking at the top of this thing.
Yeah.
I don't think the culture is going to easily change or let the USDA be absorbed into the SBA. I've been a SBA lender for over 30 years, USDA for 25 years. I literally have to take a hat off and walk into the other room to work between the two programs. It gets that different at times. I think that'd be a hard fit and not a very pretty outcome if they ever did try to merge them. I do think the USDA could use some consolidation and become more efficient, and they're working towards that. I don't see it ever being done along the same model as what SBA does now. I don't see a PLP lender having carte blanche to go do it based on USDA policies, because in reality, as I said before Steve maybe got on, the loan is supposed to be the bank's conventional loan enhanced by the USDA guarantee. Okay, so that is really where the USDA feels like they're almost a participant working with the lead bank. I don't get the same feeling with dealing with the SBA.
That's a good point.
Hey, I just want to make a comment. We were talking about the timing misconception that so many people have about USDA. That's a misconception in the market, because for a lot of people, that's been their experience of having like a 6 to 12 month kind of nightmare experience with the USDA. And Charles actually mentioned that the reason that becomes a problem largely is because lenders that don't know the program very well submit applications to the USDA that are not complete. That's
correct.
That is literally why these projects drag on forever. So, the game is like, there's not that many lenders in the country that know how to do it really well. Maybe 20. It's a small community. When you get outside that core group of lenders who really knows what they're doing, you're going to have a hard time, because they're going to submit an application to the USDA that's kind of garbage.
They're learning as they go. And
that's
not good.
Yeah. And it's not fun.
That's not good. It's not fair to the bar. It's not fair to anybody.
I see so many parallels here. It's so fun. I mean, you guys, I know we're in two different worlds here, but it's like we say this stuff with basically GP SBA lenders that do, onesies and twosies every year.
Right.
It's so funny.
I've had many a call from a USDA state office where they said, we have this bank that's been trying to submit this USDA loan application to us for a while, and they just don't get it. Do you know these bankers? Can you go take that loan from them and do this? Because we'd like to do the project, but we're not getting what we need from the bank. And
is every state different, Charles?
My experience is every state I've worked in, and I've probably worked in about a dozen states, is a little bit different. And what's happened with a couple of the states I used to like to work with, they'd have personnel change, and then it became much more difficult in that state because a person came from a different state into that office, or in certain situations, they actually came from the SBA and got hired by the USDA. And those people had a hard time understanding how to do USDA loans, and they're sitting in a USDA office, and we're trying to help them along to learn their own program. I do all my loans with loan packagers like Steve. So I'm sure Steve can add a lot more to that than I do, because usually when I run into those situations, I kind of dump it onto the loan packager. Can you go help the state loan officer a little bit? Because they seem to be having a little bit of problem.
So Steve is an invaluable resource then, it sounds like, because if you know the ins and outs of all the different states, I mean, that seems like the key to this thing.
The loan packagers are definitely, there's some very good ones out there. Yes, they can really make the job a lot easier for me.
I was just going to go back to the timing issue. I've done USDA loans in 3 weeks, and I've done them in 2.5 years. And the 2.5 years is exactly, well, it's not exactly, but it's a combination of huge construction projects that the timing was not the fault of the lender or the USDA or anybody, except for it just took that long to get permitting. It took that long to get the plans and specs. All that stuff just took time from the start of a seedling project to fruition. Now, that's under different circumstances, but a normal construction project should not take more. Take out the architectural design and a little bit of that stuff, and you're looking at 60 to 90 days is what it should take. And USDA's directive,
that's not bad at all.
No, and the national office directive that we were told at the last conference in Denver from the national program director is their goal is to process loans in 30 days or less. That's their goal.
Yeah, and they're held accountable to that internally.
So Jason, tell me, I want to go back to the underwriting of these things just so I can get a better feel for what they look like. Because I heard nonprofits are eligible. I heard investment real estate is eligible. What other flexibility is there on the collaterals or on the underwriting side? Are they all collateralized?
Yeah, great question. So generally, because I know a lot of the audience for the podcast is SBA experts. So the down and dirty real quick is that USDA can go up to 25 million. You've got to be in these specific areas. And then the real estate does not have to be owner occupied. Those are kind of the three really big differences on the underwriting side. So when you get into the collateral and the asset base on the SBA side, we can do these great unsecured cash flow deals for acquisitions and business growth. On the USDA side, you can't do that. We've got pretty strong collateral requirements. So the loan's got to be fully secured on a discount basis. Yeah, first lien on a discounted basis. It gets in the weeds, but simply it's pretty much 80% loan to value on real estate and 70% loan to value on equipment is typically going to get you where you need to be. So on the real estate side, though, it's really fun from a lending standpoint because you're in all these different asset classes. Because we can do investor-owned, non-owner-occupied real estate. So we can do industrial, medical, office. 30% on average of the annual deal flow every year is hospitality. So there's a ton of hotels that get done. And then a lot of boutique-y specialized CRE, like vineyards, wedding events, family entertainment centers, all that kind of stuff.
Wow. And what percentage of the loan do they guarantee?
80%.
No matter the loan size, it's 80%, with the exception of the timber production expansion program, which is a 90% guarantee.
Did they change that? I thought at some point it was like 70% if the loan was over a certain.
It used to scale up from 60 to 90.
Yep.
Over 10 million, it was 60. From 5 to 10, it was 70. And below 5, it was 80. But that was done away with. I don't even remember what, in 2016, I think, is when they changed that criteria in the program.
Yeah, that was a big deal. When they took the guarantee up to 80% all the way to 25 million, that's when you had all these lenders start in the ticket size.
Yeah, attractive at that point. Yep.
Yeah.
Yeah, because that's higher than the 75, whereas obviously 70 is lower than 75.
Absolutely.
See, this is why people listen to this podcast. We do that math for you here.
Come on.
So you don't have to.
Now the premiums are a little bigger.
And so we're selling into the secondary market.
Yeah, they sell in the secondary market, and typically they sell at a better premium than the SBA in the secondary market.
And there's no Colson, so there's no splitting a premium, which is a huge benefit to the banks, to the lenders.
Yeah, you guys be careful. You might be creating some new competitors here.
I actually had
making it sound a little too good.
Well, anybody out there that needs a good packager, I'm right here.
Yeah, I mean, I think you're hired. I mean, I'm hiring you, so because we'll get into it. I think we did like maybe 2 or 3, but I'm telling everyone to avoid it. But I'm retracting my statement. If we have Steve here in our corner, so
I could just chime in on the packager value. So from a lending standpoint, and I know Charles is at Bay First at Acclivity, like the packagers are super valuable in the space because of what you're talking about, Ray. A lot of banks that do want to get started. I mean, if you know commercial finance cold and you're an expert and you want to get into USDA, and let's say you know SBA, it's literally going to take probably 2 to 3 years, get 3 to 5 deals done, probably before you really feel like you've got this thing figured out. So the packager path is a great because banks that aren't in yet can work with guys like Steve that know the game, because the nuances are just kind of never ending, honestly. I mean, I know Steve and Charles, you guys have been doing it for a couple of decades. Wouldn't you say it's almost never ending? I mean, it's like constantly new things popping up.
There's new things popping up. One of the things you didn't mention, because I spent a lot of my time in very small banks, and since I've done a lot of these loans, I've had good success with banks that might only see 1 or 2 a year do a participation with them. They find a deal. They know it's probably a USDA deal. They're not comfortable with their lending staff putting it together, and I'm happy to participate, share in some of the premium income, work with my packager. We basically take it over and lead it, so they can be the lead bank, keep the servicing if they want to, because there is some servicing requirements with these too. So if you're only doing 1 or 2, you might not be set up to handle the servicing end. So over my maybe too long a 43-year banking career, 25-year in this, participation of these products, you can't do it. SBA, it's no problem with USDA, because again, it's a conventional loan with a USDA guarantee. Okay, so the ones I've taken over from other banks, sometimes I end up taking over as a lead and participating it back to them in some fashion.
Yeah, there's definitely more participation in here because the loan sizes and whatnot.
That's correct.
But I'm curious, Jason, can we hear some of the kind of deals that you're working on, just so I can get a flavor for it, maybe some recent successes you've had in USDA?
For sure. Yeah. So, like I said, a third of the deal flow is hospitality. So done a lot of hotels, and the hotel deal flow, I mean, one of my favorite deals I ever did. And this is kind of I like working with sponsors that are just starting out but are really solid and have like really cool backgrounds. So one of my favorite deals I ever did was with 3 sponsors that had all been working in the hospitality REIT space for like 10 years, fresh out of college. So they did like 10 years at massive institutions, managing hospitality assets all over the country. And then they decided to partner up and make an entrepreneurial play. And so they wanted to start out by acquiring 2 hospitality properties up in the Upper Peninsula of Michigan. Really, really beautiful spots. And they got 2 properties. One was 14 million, one was 15 million. So it was like a $29 million deal, 2 separate loans. And we were able to give them a 30-year term at, a single-digit interest rate. And that like basically gave birth to their entrepreneurial career. That was the first deal they did. I think now that was a couple of years ago. I think they've got their portfolio up to like 5 or 6 properties now. So that one's always stuck out. Yeah.
30-year term. That's
yeah. 5 more than SBA. So we go full 30 on real estate deals.
Everything's 5 more. Everything's 5 more with USDA.
5 more, terms 5 more. Prepays also 5 more. Yeah.
What about you, Charles? Are you working on any cool projects?
Well, first I want to make a little plug for the National Rural Lenders Association, and that is a group of USDA lenders, NRLA, and they do have a web page, and there's a lot. I have one large loan featured on their page right now. I did a $20 million refinance and a large equipment purchase for a company that specializes in FEMA storm cleanup around the Southeast United States. So almost all my collateral is yellow iron and heavy vehicles, just a little bit of real estate. I've done a convention hotel. I've done an exotic animal farm.
Wow.
Frozen food facility. I'm working right now on a plywood factory deal up in the Northeast. So rural hospital, that's a big deal. Several of the people in the rural hospital space have found that USDA is a good way to go to refinance or to buy another rural hospital. So there's a lot of different types of loans I've done over the years, but again, also done a fair number of hospitality, especially RV parks. Used to be able to do mobile home parks, but you can't do those now in B&I. Those fall into multifamily with USDA, but you can still do an RV park with the USDA.
I basically you just go to the website, you plug in the address, tells you yes or no. That's the first thing you've got to do on these loans, right?
That's correct. Yeah.
And then it doesn't count towards the cap on this SBA. So a lot of people, can go get 5 million from SBA and then still have, is it 25 million total in USDA, or how's that work?
Well, first of all, when you plug in the address is project specific. The FEMA company I did was in it. Their headquarters is in a city that's not eligible, but all their project is outside of that city, and that's how we qualified them to be eligible. So again, it's project specific on the address. And some people fall down on that. They think, oh, my business is in an eligible area, but they're trying to do a project not eligible, or vice versa.
Right.
Yeah, no guarantor limit, though, which is nice. So you could do an uncapped amount of USDA B&I loans as an entrepreneur if you're a hotelier or sawmills or whatever.
You're kidding.
Yeah. Yeah. And there's no liquidity net worth cap either. And on the SBA side, they don't want you to be too wealthy. On the USDA side, we're regularly doing deals with people that are 50, 75, $100 million net worth, that are just, this is their lowest form of capital. So you can be wealthy and participate in the program.
Yeah, I did a 5,000 acre timber land deal for a large insurance company as an example of a USDA loan I did, because timber, even though it seems like it'd be an ag product, it's considered business. And that's the other thing about USDA B&I. can't do row crops or cattle within B&I. So everybody hears USDA and they're thinking it's a farm loan. Well, other than some very specific type of ag, you can't do it in this program. There might be there's FSA loans, but the USDA B&I program is not geared towards any normal ag type of business.
Is there a job requirement, like for every dollar, of loan, you have to create like X amount of jobs?
Not specifically. They like to know if you're creating jobs or retaining jobs, but no, there's not a dollar tied to a number of jobs.
Are you guys concerned right now that like in this where we're at in government, like we're seeing cuts, we're seeing Doge, we're seeing all this stuff. And, I'm looking at a program here that, hey, 25 million, for someone who might have a lot of money and, we've got to pay for this program and, why don't we just absorb that into the SBA? Are you guys not concerned about that?
No, because the program pretty much with its fees pays for itself. Just straight up, the fees they collect cover the overhead and any losses. That's before the multiplier effect of the business created and the tax base and the jobs created and the tax base that comes off of those jobs. So really, this is very accretive to the government. It's not a cost. It's actually a money-making venture. I mean, how many programs does the government have other than tariff collection where they're actually making money? Okay, so
I've always heard it was the only one. I don't know if that's true or not.
The SBA makes money most years, I think. Although
that's why
we don't really know.
Charles Conoley's saying, and you guys are saying, coupled with that, right now, talking about morphing with the program, the country's morphing back right now. We're morphing. The amount of investment coming back into this country is incredible. What that's going to do is that's going to drive smaller business to support all this investment coming back in, and they need access to capital. They need it everywhere they can get it. If you restrict this and try to pull this away, that's just taking more access to capital away from something it's going to be desperately needed. We might not see it right this second, but in a year, 2 years, it's going to be at full capacity every year. The money will be sucked out every single year, in my opinion.
Steve, are you seeing rise in defaults in last couple of years like we are on the SBA side?
I'm not on our side because when we underwrite USDA loans, we underwrite, for the business, the operations, all the, character, collateral, all those sorts of things.
But what about the rates though going up? Like aren't they mostly variable rates?
The rates going up. Well, I tell you, we just had that effect the last few years where the rates shot up almost overnight to the bars. It seemed like overnight. Well, that scared the heck out of everybody. Scared the banks, scared the bars. It tightened up during that time. Did our default rates or any of that push default rates up? Not on the loans that we have been part of. Our portfolio is a mix of all kinds of different types of businesses, from soil manufacturers to hotels to wedding venues it's a mix across the board. But we try to look for, like, for example, when we do hotel, we haven't lent, in my experience, I haven't assisted in a lot of hotel fundings, but the ones that we do are going to be resort destination type hotels that can weather economic downturns. That's what we look for. We don't look for the highway hotel, so to speak. If that makes sense.
Steve, why doesn't the USDA centralize tomorrow? Like, why is it all done through these district offices? It just seems like not efficient. It
could be, but it's not. And why they haven't done it is, well, you had the old guard for so long, and change was kind of something they didn't want to do. And you got to a point where you had, unfortunately, you had a lot of employees that weren't pulling their weight and so forth, and that added up, from state to state to state. So now they're at a point they have to do something with the early deferments and all that, and the staffing shortages. They're forced to do something at this point. They have to do something, and that's what we're seeing right now.
I think they do like the fact that they have local people in those local markets that can do site visits, can understand those communities where we're trying to do loans.
Well,
So I think
everybody
that's
understand, Charles, I'm sorry to interrupt, but everybody's got to understand that this program started and was basically given to USDA because they were scratching their heads back when it was originally developed under Farmers Home way back. I think it was the 60s or early 70s. Well, they said, well, okay, we need to get access to the markets out there because there was interstate and intrastate banking back in the day. If you're a bank in a big town like Tampa, you couldn't legally go out of your area in Florida and lend. So you had restrictions. The guarantee allowed these small businesses to stay out in the rural areas and grow. And the guarantee provided the bank a way for them to get around the legal lending limits, the capital requirements that are required. So the little bank can make a big loan now instead of the little company moving to the capital. Now the capital would come to the money, to the business. So that was the whole crux of it. And the next question was, well, how do we administer this program? Well, they already had offices all over in the rural areas. So it was, okay, USDA will administer this because it's rural. So it was kind of a no-brainer for them to assign it to USDA because all the area offices.
Yeah, that was before we had Google. That was before we had Google Maps and
right.
All this.
And back in the day, those folks and the farmers, they relied on those area offices, those local offices heavily. And they played a lot bigger role 25 years ago. Those area offices, those local offices played a much bigger role in the whole lending process. And we've seen that go away. We saw it go from the local office just disappeared and it went to the area office. Area office disappeared and went to the state office. Now it looks like the state office is going to go to the national office. So,
I mean, it sounds like it's going to happen to me just because there's no reason why why it shouldn't. That's my opinion. And I know a lot of people will disagree. And I know it's nice to have people in the markets who know the community and making local decision-making, but that's how SBA was.
Mm-hmm.
And it changed. Mm. And it just seems like SBA is lagging the residential mortgage industry, I think. And I think USDA is lagging the SBA industry.
That's exactly right. And local agencies, the local folks, I mean, they're helping primarily the farmers, and they're to support the farmers. What in the heck do they know about doing multi-million-dollar loans for a hotel? And that's what we've done.
Yeah, and then, but it is so small that probably no one's paying attention. So you guys probably be good for another few years, maybe decades. Who knows?
Yeah, well, $1 billion here and $1 billion there, and pretty soon you're talking about real money, though, right? So no, this is a multi-billion-dollar program, and the secondary market's tens of billions of dollars at this point in time. So it's not that small. Yeah, it's not SBA size, but it's still a pretty sizable type of market.
And right, if it was to be absorbed by SBA, there would have to be some very big mechanical changes in the regulations and how it's done. With the gap balance sheet equity stuff and all that going into it, it would, because you really can't, it's hard to cross over from one to the other.
Yeah, Bayford's one of the largest SBA lenders in the country. And I came here to do USDA. And SBA works off of tax returns. USDA works off of gap financials. So even within
that's what you're talking about.
Even within my credit area,
wow,
they struggle sometimes. Like,
yeah,
we got this. I said, no, that's the tax return. We're working off the gap financial statement.
Interesting. That's really interesting. All right. Well, we're going to wrap up, but I want to ask you one more question, Jason, and the rest of the gang. But like, if there was one thing that you would just want to, change right now, wave your magic wand in USDA land, what would it be?
It would be efficiency in the process through USDA, which I think they're making tremendous progress right now. A gentleman named Brian Wiles has been appointed as the administrator over the last year or so. And he's driven some amazing changes to try and get it to be a more efficient process. But I think that's what all the lenders want, is just like efficiency. And the game right now is the only way it's really efficient is the lender being super active and really being an expert in the program. And if you could just wave a magic wand and it was efficient for kind of everybody, that would be great.
My biggest pet peeve is the environmental regulations, RD 1970. And if they could just get rid of all of that, I would love that. But right now, again, that's kind of morphing. We don't know what the end result is going to be, but I really wish they would decouple from that environmental process.
So when you say environmental process, are you talking about like phase 1s and phase 2s?
No. USDA requires they have a separate regulation called RD 1970 that is just USDA regulations on environmental. Those mirror the NEPA regulations. So when you do a USDA loan that's ground up construction on it doesn't have to be sensitive. If a wooded area that hadn't been touched in a while or something like that, you've got to do the full NEPA study, which is tribal letters, the
historical, tribal,
all that. It takes months. You sometimes have to do
floodplains,
months for a study, and then it's just to say like what impact will this have on the environment.
Yes, and let me tell you, the crawl on that is sometimes, occasionally, you'll get a new USDA, a person recently put in that environmental position. And I've been doing it 29 years, and they'll misinterpret the regulations. And we had one situation where we were putting up we were replacing a outside asphalt basketball court with a steel building gymnasium on this exact same footprint, and everything around it was the playgrounds, and then the school was behind it. And they call previously disturbed land. You're supposed to be exempt, or what they call categorically excluded. They made us do a full NEPA report on that, which I fought tooth and nail, but we couldn't get around it. But that was somebody that had just come into position. They misinterpreted. And it's one of those things, we either fight them for 6 months or we comply and get it in 3 months, right?
Has the study ever come back and then you couldn't do the deal?
No, because normally I'll do some pre-qualifications. For example, I had a loan up outside of Tampa, and these people had a contract to buy a 30-acre piece of property to put a new charter school on it. The first thing I do is I look at the location. I think, as Jason pointed out, these loans have to be used in a city or town with less than 50,000 of population and not contiguous to an urbanized area. So they got to be out in kind of rural areas. After I did 10 minutes of research, I found that this property was in a protected wellhead area. I went back to them immediately and said, you will never build anything on this property ever. Don't buy it. So that's part of what I do is I try to stop people from getting.
So you're basically an environmental lawyer at this point. It seems like
sometimes it seems that way, Ray. Sometimes, and I think Jason and Charlie can say the same thing on that. They put this hat on and that hat on, and you got to protect them wherever you can.
Well, is that change something that would have to happen through Congress because it's written to like CFR is how it is
it's been changed
in our side.
It's been changed, but now we're waiting for the final verbiage to come out exactly how that's going to affect us. So we don't really know what the change is until they write it and send it out.
That's interesting. Okay. Well, wow. Okay. And let me just go to you, Charles, just to round us out here on any changes that you'd like to see in the program.
The biggest thing with me is the personnel change and getting the staffing right. I don't care if they do it in the state or if they do it in a regional or they do it in national, but there's been a lot of moving pieces, and when the people are moving and they're not sure about their job, I think it slows down the process. So as we go through this upheaval and reorganization, hopefully that gets corrected. But right now that does make it a little hit or miss because I am in multiple states. So if I'm in a good state, it's great. But if I'm in a state with some changes, then that definitely becomes a problem because now I got to work differently. So get it standardized one way and let's move forward. Because you got to remember, I got in this 2001 up till 2016, nothing changed. It was done the same way year in and year out. And then up through COVID, after they changed in 2016, they just tweaked it. It still pretty much was done the same way.
Mm-hmm.
But these last 4 years, especially now with Trump in office, changing again, if it could settle down for a year or two, that would be great. So
I hear you there. There's a lot of similarities here on both sides of the aisle with SBA. Didn't they like run? I remember at some point someone was like, "Hey, we're trying to get a deal done," and they like ran out of money. And I don't know if it was on the state or federal level, but they were just like, "Hey, we're just waiting for them to have more money."
Yes,
and the project's on hold. Like,
That
what's that all about?
That's happened to me several times when we get a continuing resolution and don't get one and the government shuts down, or if they just run out of their money, then you have to wait till the next fiscal year when they refund the bucket. We used to try to get all of our approvals done from the USDA by mid-June because we didn't want to go into the last 2 months of the government fiscal year worrying if we were going to have money and have to wait till October. I've had a couple times when I did have to wait on a deal until October. So
right. That's usually rare when they run out of money because they start getting short. They'll start getting short early in the summer. And they used to pool whatever state still had remaining funds. They pool it all together. So then it would.
Okay. It's state by state allocated.
Mm-hmm. Yeah, it was just state by state allocated. So they would get a pool together. Now, oddly enough, when they'd run out of money, like they did that this past last year, they ran out of money, but they somehow find a little bit more to put in.
Yeah,
mysteriously find $100 and something million. So they're able to and usually the loans that are that miss the funding, it's just a few weeks they have to wait. It's not
right. It's not forever, but it could be a few more weeks delay. That's correct.
Well, you would think for a program that's making money, they would find some money and keep
usually
you guys
do.
Going.
Mm-hmm. They usually do.
Which by the way, just keep an eye out on your secondary market premiums because there might come a time where the government says, "Hey, we want to take a cut of that." It's happened to us, so just keep an eye out.
We won't talk about
that. Would be a game changer.
Yeah. Well, they split it after 10% with us. That's that's how it goes. So they talk about changing that up and doing different things. But in any event, this was amazing. This was so much fun. I'm glad we got a chance to do this, guys. Thank you. We'll leave all of your emails here, Madison. We'll put them in the show notes. In case you want to reach out to these guys, the only 3 people in the nation that know anything about USDA. Fellas, thank you. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The BDO Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.